Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Don't forget to hit the subscribe button. Now, it's a big week in the markets, of course, and spot gold has hit a new all-time high. You have hovering around that $2,600 mark just days before the Federal Reserve's next rate decision. Now, the big question is, everyone is asking, of course, is will the Fed go for a 25 or a 50 basis point rate cut? Now, the decision is crucial as it could either fuel gold's rally or, of course, cause a little bit of a pullback here, depending on how the markets react. Now, beyond the Fed's potential move, the weaker dollar and falling bond yields, now close to 3.6 year on the 10-year, have further supported gold's recent surge. And at the same time, we can't ignore the global impacts of China's economic slowdown, which has shaken up markets and boosted demand for safe haven assets. With all this momentum, there's still some skepticism. How long can the rally really last, and what will the charts tell us about where gold's headed next? Well, of course, joining me today is Gary Wagner, editor of thegoldforecast.com, also Kitco's resident technical analyst, to take us through the technical side of things. Gary, welcome back.
Thanks for having me. And what an exciting start to a week in gold after last week's incredible historical move to the upside, breaking above $2,600. Something I wouldn't have thought was possible years ago, and we're staring it right in the face today. So, yeah, exciting time to be looking at gold.
Yeah, it's a fascinating time. And then, of course, we're waiting on incoming economic data all week long. Of course, we have that upcoming FOMC meeting just days away. How do you see the Fed's decision impacting gold in the short term here, Gary?
Gold's going to be exceedingly sensitive to what the Fed announces when they conclude on Wednesday. The key right now is that it's considered a certainty that there will be an announcement by the Federal Reserve to cut rates to some degree on Wednesday. The question is whether or not they will cut by 25 basis points or 50 basis points. Those odds, and this is according to the CME's FedWatch tool, have been dynamically changing. And this morning, for the first time since I have been watching all of this unfold, we saw the probability of a 50 basis point rate cut exceed the probability of a 0.25% or 25 basis point rate cut. So gold will absolutely be sensitive. My sense is that current prices have factored in A, a rate cut, and B, a rate cut of 0.25%. And so I'm not convinced that we won't see gold take off if the Fed cuts rates by 50 basis points. And that's going to be what traders, investors, market participants are going to be kind of glued to their screen or to their television watching the Fed announcement in a couple of days.
Yeah, interesting. I mean, as you mentioned, 25 basis points, I think that's what you're saying, is baked into the gold price now. I mean, we started the year covering 5, 6. I'm curious, I think what you just said, Gary, was that you're not counting on this rate deliverance of whatever the basis point cut is to have a huge effect. Is that what you were saying there?
No, I'm saying the gold will be very sensitive to the rate cut. I believe that if it is a 0.25%, 25 basis points, that's been factored for the most part into pricing. However, we could easily see almost anything happen. And the reason I say that is the dynamic change in the CME's FedWatch tool. And what that tool is, that probability indicator that everybody looks at, is they're taking and gauging interest rate futures traders and what they're placing their bets on. And that's where the probabilities are derived. So right now, what it says is that futures traders, the professional money managers, those who are active in trading interest rate futures, now see the most likely outcome, a larger rate cut, a 50 basis point rate cut.
Yeah, been fascinating watching it flip back and forth between the 25, the 50, and then, I've even seen some tweets this morning suggesting that they should go to 75. So, of course, we'll be watching what they do here. When you bring up the chart on gold, Gary, It seems like it's been trading above both the 50-day and 200-day moving averages. How significant is this from the technical perspective?
Well, of course it is. Let's go ahead and pull up our moving averages because you just brought them up. And what you see on this chart is three lines. The short term is a 50-day moving average in green. Below that in a deep blue is the 100, and well below that is the 200-day moving average. The 200-day moving average is what we look at in terms of the long-term view of a market because it's basically the moving average of a year in time. And the 50-day is what most people follow. And you can see that ever since the end of July, gold has traded effectively above the 50-day. It had been above the 100 as well as 200 for a tremendously long time. Let's go ahead and center this a little bit better. There we go. So you can see that in terms of the moving averages, gold is in what's called a classic bullish formation, in which A, pricing is above all three moving averages, 50, 100, and 200, and B, you look to see if there's a widening, let's say between the 50 and 100. You can see that how narrow it was here back in August and how that's widening. And that's what we call classic bullish alignment in terms of the moving averages.
Interesting. Okay. So if we see gold dip below the 50-day moving average, would that signal maybe a potential shift in the momentum, or do you think that the broader fundamentals are strong enough to keep this, keeps gold's bullish trend intact here with what we're seeing?
Well, think of it this way. A moving average is what we call a lagging indicator, meaning it derives a reading that is, in essence, behind the actual movement because it's a moving average. It's looking at 50 days, it's averaging it. So it's never a leading indicator telling you where it's going to go. It's a gauge to tell you whether or not the overall demeanor of the market is in a bullish, neutral, or bearish demeanor. And so you're never going to get front-running information from a moving average. It lags by the nature of the formula itself. It's averaging out a data set. The longer the data set, the less sensitive it is to real-time data or current pricing.
Okay, let's talk a little bit about the sentiment in the market, though, because the RSI, or the Relative Strength Index, is sitting in a neutral zone, not yet signaling overbought conditions. How should traders interpret this, especially, given the uncertainty surrounding the Fed's next move?
The RSI is this purple line on the bottom. And so I'll draw your attention to when it peaks. You can see the color change. So what we're looking for is moves above 70 or below 30. And so take, for example, this move that occurred on Monday, March the 11th, right here. And then you can see that the RSI goes down, and so does gold. If we look at a peak here, we draw it up. It's lagging a little behind, but it did give information of a potential overbought scenario, and it occurred before gold would dip again. So that's what you look for in the RSI. And so what you're pointing out, correctly so, if I understand the comment, is that we are not looking at an overbought scenario. In other words, you look at overbought, for example, what we're seeing back here in March and April, when it goes into this yellow, it's above 80. And that's when it is in a scenario in which it's likely, because it's overbought, that you will see a reversal, a flip from bullish to bearish. And we're not at that point yet because it's right kind of in the middle. And that's the point that I believe you're making, and that's correct. Means that gold has further to go to the upside based on the RSI.
Further to go. Okay, well then what everyone's been waiting for, Gary, what's the outlook here? Where is gold going to be going? It's, September, we're waiting on that FOMC meeting. Obviously, we have a lot coming up with the election too, but what's your short-term goal?
Right now, my target very short term is about 26.25, with the potential to go as high as 26.50. That's based on the sidelines you see, which are basically a Fibonacci extension. So in other words, we look at this leg of the rally that began June 26th, gold sitting at 23.55, up to the conclusion before it corrected 25.30. And so you take the dollar move that it has, and then you begin to plot from the beginning of the next rally, which we labeled as a wave 3. In other words, after this price correction. And so a 1-to-1 move, meaning if this rally right here is equal to the current rally going on now, then it would be at least a 1-to-1 move, and we exceeded that last week. We're looking at a daily chart. This is Friday. This, of course, is the big move on Thursday. We could easily see it go as high as 26.25 to 26.50, but the caveat to that statement is where gold goes midweek will really be tied to the announcement by the Federal Reserve. For example, no one believes this is a likely scenario. If they announce that they're holding rates where they were, they're not going to cut rates. Now, Powell's already said that it's ready for a policy change, so nobody believes that's likely. But if that occurred, we would really see gold prices decline because we're factoring in a cut. If the cut comes in, as you mentioned, at 75 basis points, and I haven't heard that one, I think that's highly unlikely. No rate cut, I believe, is absolutely improbable. 75 basis points is highly, highly unlikely. I wouldn't put any kind of odds to that. And so where gold goes will be really sensitive to what the Fed announces on Wednesday when they conclude their meeting.
I know. I mean, it seems like these prices, though, but past that $2,500 level, it almost feels like, knock on wood, it's the new normal here when we're looking at spot gold.
I've been looking at gold for years, and to me, that hasn't sunk in enough where I believe this is a new normal. It is the new price point that we're looking at. It is where we're at. So by virtue, it is the new normal. It is what we're witnessing. Can it sustain and hold this area? Can it move higher? Can it find support, say, at 2,600, which is what I believe should happen? But realize this, Jeremy, we're in uncharted territory. Recently, throughout the beginning of the year, when we hit our first top back in April at around 2,500, that was new uncharted territory. Comes down to about $2,350. Then it makes another run for it, but this one has got a higher closing price, but it's still within the level of what this wick was, meaning the intraday high, not a closing price. And so we had basically a triple top. And then we traded sideways. You can see that here on these daily candlesticks. One, you have alternating candle color, and you've got a price point that is really between 2,500 and about 2,560. So we were looking at support, major support at 2,500, major resistance at $2,560. They took that level out on Thursday. Traders moved it even higher on Friday. And rather than retracing at all today, we're up fractionally a couple of dollars, which is nothing, but we're still in the positive on the day. And that's after traders, market participants, investors have had the weekend to kind of absorb what we've seen in gold over last week. So that's strong. The key is going to be the announcement by the Fed. Technicals are a very good way to gain insight. but the relevancy of a technical indicator when we're waiting for a Fed announcement is almost nil. The market's going to move because the Fed does whatever it does, and not because the moving average is here, not because any technical indicator is issuing a basic signal. It's all about the Fed.
Yeah, it seems like it has been. What a wild ride, Gary. Okay, before I let you go, let's talk about silver, because on the other hand, it hasn't seen the same surge as gold, hovering around $31. Do you see a catch-up rally for silver, or the fundamentals just different here?
Well, let's look at it this way. Recent action in silver in terms of going to a high have been around $33. Middle of 2011, gold breaks above a level it's never been at, $1,900 per ounce. We look at that now as inexpensive, but that was big. And at the same time, silver moved to $50. What followed after the all-time record highs came in both gold and silver was actually took an exceeding amount of patience, because between the middle of 2011 and the end of 2015, we watched a slow and methodical price decline in both metals. Gold went from $1,900 till the low at the end of 2015 of $1,020. So it basically lost half of its value. And then a rally began, and it built steam, and then went to multiple all-time record highs and closes. At the same time, silver never challenged or got near $50 an ounce. And this is the recent high at $33. This is what I would look at. If gold continues to rise, I believe silver will take out $33. If gold continues to run, silver could maybe challenge $35 to $40. But there's no indication currently that silver is going to make a run for its all-time high, which is around $50.
Yeah, well said. Okay, well, we'll continue to watch it here. Are you having fun, Gary? What a couple of weeks, huh?
It's fun. It's interesting. It's dynamic enough to make you not certain about what you would typically believe, because, as I said, we're in uncharted territory. So as a market technician, we don't have the same kind of tools that we would in gold. Silver is not as hard because we're underneath the recent high and well underneath the all-time record high. It's an incredible time to be involved in the precious metals markets. That's my take.
Yeah, well said. Well, we appreciate it as always. Gary Wagner from thegoldforecast.com joining us to break down the charts. We'll have you on in a couple of weeks, my friend, and see what this rate cut or potential rate cut is in store for metals, and look forward to hearing your next outlook. You've been spot on so far.
We'll see what they do, and it's going to be an interesting week. Absolutely.
Yeah. Thanks, Gary. Appreciate it. I'm Jeremy Szafron. We will have all the coverage on the economy, of course, gold all week long. Hit that notification button and stay tuned. We'll see you next time.